Session on Decoding RBI's new directives for lenders investing in AIFs. Moderator Mr. Ashish Agrawal, Director, Resurgent India Limited. Eminent speakers Mr. Nilotpal Pathak, Partner, Sagesha Growth Partners LLP. Mr. Vineet Ranjan, Head Risk Credit, Kosh. Mr. Varinder Gulati, Founder, Sarvasv Capital. Mr. Vijendra Shekhawat, CEO Executive Director, Choice Finserv Private Limited. Mr. Vikas Dugar, Head of Corporate Venture Capital Global M&A, Cipla.
Good evening, friends. I'm Ashish Agrawal from Resurgent India Limited. I would like to welcome to all of you in this today's webinar on the RBI new directive on the investments by RE in AIFs. RE means the regulated entities, which are banks and BFCs. And this regulation or this circular came in the picture on 19th of December. And RBI has issued directive mainly for the investments from the regulated entities, which are basically regulated by RBI in the AIF funds. So we have three categories of AIF funds, category 1, 2, and 3, where the RBI has shown concern about some evergreening of the portfolios of these REs by way of investing indirectly directly through AIF. So they have given this directive in 3-4 ways, which I'll just discuss with you. But I would like to welcome to all the panel speaker for joining with us, all our industry veteran. We have seasoned banker, NBFC founders, then we have corporate M&A heads also. And these are the people who are practicing the investments on daily basis or lending on daily basis in their businesses. And so nobody can be better than them to discuss on this decoding of this circular, basically, whether this is the right step or there should be some modification, or what will be the impact on the overall the RE business also, or the AIF domestic capital availability also, and how this as per the RBI directive, they have to liquidate the investment. So will it be possible for them or not? So these are some of the issues which are very related to this topic, and we have panel which will give us the guidance or throw the light on that. And I hope that the audience who is joining with us, they will definitely get some advantage out of it. They will know the directive in detail. And we have people who are joining with us in the audience from the different industry, different backgrounds. So we have bankers, we have AIF practitioners, we have professionals, then we have industry people also. So it's a combination of a different kind of people from the different background, and they would like to understand more. So I will try my level best to give you the complete perspective of this directive and how it will shape up in the future. From our point of view, we will definitely try to cover it. So, so the flow of the program will be very simple. I'll just start with some small PPT, which will give you the whatever the RBI directive is there in that cell and in the detailed manner. Then I will invite the panel for their deliberation, their views on the topic which we are discussing today, related to directives for lenders investing in AIF. So friends, I told you that RBI came with the directive on 90th of December. There are 4 things they have covered in that actually. So they have instructed to the regulated entities not to make investment in AIFs, where the downstream investment is there in the directly or indirectly in the loans or investment of the regulated entity. So this is the first directive which they have given, that future there should not be any investment in AIF which has the downstream investment through loans and the investment through RE. And the second aspect which they have covered, that if any investment is already there, then it should be liquidated within 30 days. So that's another directive which the RBI has given, which is very, very important, keeping in mind the current scenario where there is no regulated marketplace for the investment liquidation of the AIF, like mutual fund or maybe the stock market, actually, say the capital market. So this is, I think we need to discuss on that. Then the RBI implemented from the immediate effect, actually, from the day of zero, actually. So from 19th December, it will be applicable. So that is another aspect. The time is less, and then there was no time has been given to consider it in a proper manner. And the RBI has covered one more thing also, that if the investment has been made before 1 year also, that also it is also covered in the circular. So these four things are there. One is that further investment should not be done. Another is, if the investment is done, it should be liquidated from the within 30 days. And the third thing, this investment, basically the past investment is also covered up to 1 year past investment. And then the fourth thing is this should be liquidated. This is effective from the day zero, actually, from 19th of December. So almost, I think, 10 days are already gone. So 20 days are left. So this is the brief of the whatever the RBI has given the directive. Now I'll come on the next slide. Rohan, can you just come on the next slide? So we have just tried to work out what will be the impact of this circular on the NBFCs and banks, actually. So definitely it is clearly given in the circular that if they are not in a position to liquidate this investment, then they have to have the provision of this investment in AIF of 100% of the capital provision will be required, actually, which will impact their tier 1 capital. And this will also impact the CAR also in case of NBFCs. And NBFC or banks will try to dump these units in the market whenever possible at the throwaway price. So again, it will impact on their profitability. And there may be, in some cases, there may be downgrade in the ratings also, which is a very, I think, serious concern in case of NBFC, because if the downgrade is there, then definitely the availability of fund for them and the cost of fund will also increase. And then the funding availability will also be impacted. So there are certain areas which will be impacted if this will be implemented in the same manner which has been basically announced by the RBI. Next. So this is just brief about the industry, AIF industry in the country. So many of our people who have joined us or who are joining us, they will not be having much of the idea or a detailed idea about the AIF industry in India. So currently we have almost 1,222 AIFs which are registered with SEBI under the three category, AIF 1, AIF 2 and 3. And out of that, you see that they have received the commitment till June 2023 of 8.44 trillion, so almost 8,44,000 crore. The commitments are there from the various investors. And in this all three categories, AIF2 has got the commitment of more than 80% in the overall the scheme of the AIF, actually. So it's a huge amount, 8.44 crore, 8.44 lakh crore is a big amount, actually, which has been committed by different domestic or the international global investors to the AIF industry in India. And this is basically, they have basically have the 3.5 million investments. So out of 8.44 trillion rupees commitment, they have invested 3.5 trillion. So 3.5 lakh crore has already been invested in the various companies or various investee companies through the different instruments. So almost 40% of the commitments have already been invested in the market. And if we go through this circular directive, then we could this is announced in the media also, the public news that some of the large NBFCs will be impacted a lot with that circular. So companies like IFL or the Piramal or India Bulls or Edelweiss, these are some of the names which are known in the public now, basically, but there may be some other names also. On the other side, if we see, so the banks have also funded to the AIF, giving the money to AIF. But the overall kitty of the banks is very small in terms of their size and the investment which they have done actually. So if we see the Piramal and the Diabol and all, they are having the two-digit or more than two-digit, the two-digit investment in all the banks. This is the one-digit investment and the which is on the lower side of the one digit. So the bank like HDFC, ICICI, SBI, they are the banks those are investing in AIF. But it looks like that they will not be impacted much because of their size and their investment size also in the overall scheme of AIF. Next. So, as I already told in my earlier slide, this around 15,000 crore been invested by these 4, 5 players in the AIF from their NBFC, from their regulated entity. So definitely, it looks like that it will be very difficult to liquidate that investment. So they have to do the provision of this much amount, which will be impacting their profitability also and their tier one capital car ratio also basically. So although the lot of studies are going on by different people on that, but let's see how will be what will be the impact of after 1 month. We'll know that what will be the situation, who will liquidate and who will do the provisioning in the books. Next slide. So these are some of the suggestions which we think that the RBI and the industry can discuss on that, debate on that. So uh, it should be it should not be applicable on the investment which are already done. So practically whatever has happened actually. If it will be applicable to the investment, definitely it will impact a lot on the overall RE industry. Then the 30 days period again is very less. So as I told that liquidity in this AIF units is not all actually. There is no secondary market. There is no regulated market also. So it's been very, very difficult for the genuine player to liquidate their units in within 30 days. So I think this would also be considered that the RBI should think of, or SEBI should think of creating some kind of regulated secondary market for the liquidation of these units, so that anybody who is investing is not stuck because of maybe the liquidity not available or these kind of directives are coming. So they should have the option to exit actually. And what we think that this 100% provisioning requirement, I think they should give at least 90 days time. And the most important thing, the developmental financial institutions like SIDBI and NABARD, where basically they are responsible for the developmental activities, where they are doing investment in AIFs, they are doing the developmental funding also. So it looks like that from this circular, they are also covered in that. So I think it will be good if these institutions should be out from the directive. Then definitely it will be helpful. Because I was talking to SIDBI, they have some funds which they have sponsored and they have invested in the units of the AIF. And further, these funds have invested in were given the money to the investing company where the SIDBI is the lender also. And this is basically on the arm's length basis. These funds are basically running by the different the fund houses and all. So we should see all these aspects before I think RBI should reconsider it also. And again, the banks the many banks who have invested like SBI and other banks invested in the different AIFs, various AIFs which are managing by the the professionals, those are basically industry professionals. So if there is no linkage with the same group entity, I think this should not be covered in that also. These are some of the suggestions, but definitely we have panel speakers who are well aware and they are having the detailed understanding of the topic. So we'll be happy to take their suggestions also. So, Rohan, thank you very much for running this PPT. So, friends, now I would like to invite the panel speakers from the today's panel, and we have veteran of the industry. So, I would like to invite Mr. Patak, who is the partner of Sagacia Growth Partners LLP. So, it's again AIF, and Mr. Patak has more than 20 years of experience in the industry. So first of all, Mr. Pathak, welcome to you in this today's webinar. And think you have the career, the fund manager and investment banker also. So we'll be happy to understand from you basically the what will be the impact on the current investment plans of banks and NBFC in the AIF. So one is that whatever has been done, it has done basically. Whether the future investment will be impacted or not. So we'll be happy to know from you on this topic. So it will be helpful to our audience to know whether there will be any impact on that. So over to you, Mr. Patak.
Thank you, Ashish. Thanks a lot for having me on this webinar. And you are absolutely right.
So Mr. Patak, are you there?
Yeah, I'm there. Am I audible? Hello.
Yeah, now you're audible.
Yeah, thanks a lot, Ashish for having me here. And I think it was a very comprehensive.
Mr. Patak, please carry on.
Yeah, it's a very comprehensive presentation, and it throws light on. Hello, am I audible?
I think Ashish, there's some lag between you and Mr. Pathak. But Mr. Pathak is very well, we can hear him very well.
Okay, thank you. So you are absolutely right. This, the circular that has come from RBI has created a disruption, and a disruption which, of course, there is a basis for what RBI has done, but at least for the time being, it has created a disruption, and it has created a disruption both for the banks as well as the AIFs who have the fund commitments from the bank and who have got the investment relationship with the downstream companies. So immediately, the directive which prescribes the banks and AIFs to withdraw or liquidate the investment within 30 days is going to create a massive disruption. And certainly for the AIFs to withdraw their investments within 30 days from such companies is extremely difficult. We all know how AIF and the investments, and more so equity investments, function in India. So finding an exit route within 30 days for them would be very, very difficult. Now, as far as the banks are concerned, for them also it's not easy, because most of these loans are not very liquid, and finding a buyer for such loans, or having the for the downstream companies to have the liquidity to give them to return the money is also very, very difficult. So it's going to create a situation where many of the banks are going to be on the defaulter side, and there will be problems over there. What is important here is to understand that AIFs have got their own regulatory framework. They are regulated by SEBI, and SEBI has its regulatory mechanism in place to ensure that the practices that are not required, that are not desired, are controlled. So somehow we also believe that this directive has affected, or in a way undermined, the role of SEBI, and perhaps a more coordinated and more consultative approach on this would have been helpful. We also know that not all AIFs are completely dependent on the funding from the bank. At times, their exposure to such banks is limited to less than 20%, or maybe even 10%. And in all such cases, if the downstream company is going to be affected on account of this directive, it's not good for their portfolio health as well. So overall, as you have rightly pointed out in your presentation, Ashish, this needs to be viewed more pragmatically and more empathetically towards the portfolio companies. More time should be given to ensure that ensure two things. One, this ever winning of the portfolio which is being practiced by some of these portfolio companies stops, and two, the AIFs who have been compliant, who have not been involved in any such practice, and their portfolio companies do not get unduly penalized on account of this. So that's my limited submission on this.
Thank you, Mr. Pathak. I think you have given the good perspective. So, if you can add on that regarding this the future investments. So, one is that already investment has been done. What is the regulation for investment by banks and the REs or the NBFCs in terms of capital provision, and also this is again, I think this needs to be discussed also at this juncture, whether because of this the banks will hesitate to invest further. Or
yes, so clearly I think this will put an immediate end to banks investment into AIFs, and also the AIFs would be extremely careful while carrying out their due diligence. They will make sure that wherever they have received the money from in the past, as far as the LPs are concerned, they would be very, very careful in investing in companies who have got such banking relationships. So more than, because companies have more options. They can, if they can't receive money from one bank, they will go to another. But as far as the their relationship with the AIFs is concerned, they have more options. So banks will have the AIFs will be more careful while carrying out their due diligence. And as far as banks' participation in AIFs is concerned, that is going to be hampered immediately. I don't see any fresh commitment coming to AIFs, at least for the near foreseeable future, as long as this directive is in place.
thank you very much, Mr. Pathak. I think you're very well covered. So, friends, now we have Mr. Vineet Ranjan, who is head risk and credit of COSE. COSE is a fintech come NBFC, and Mr. Vineet has very good experience, past experience in the various aspects of the lending and the investments. So, Viniji, I'd like to understand that RBI has raised this concern of evergreening actually. So, evergreening of loan basically. And what would be the situation, or what would be the impact on the genuine transaction actually? Should the regulator make an exception for such transactions, or it should be part of that only?
Thanks, Ashish. Thanks for the intro. So certainly, yes, in terms of RBI regulating these entities, there would be certain entities wherein banks would have given genuine lines of working capital. For example, they might be running a cash credit or certain working capital lines in terms of LCs, BGs. So certainly there would be constraints, and how would those lines be revoked? That's certainly a question. Secondly, so certain amount of these funds would generally be taken in terms of growth. So for example, if you're considering refinancing of certain loans, so for example, 400 to 100, maybe 100 might be refinanced, but 300 might certainly be used for growth. So how to put a cap on that growth of funds that might have been used through the AIF by an entity? So certainly RBI has taken a quick step in terms of introduction. They found a problem statement, but in terms of solution, there was no solution as such. So certainly there are some restrictions around this. And in case, if we look at the bank's perspective, in case they go for a liquidation, there's no secondary market for liquidation within India. In case they go for a mark-to-market transaction, I see a loss of around 30%. And that's too big a loss for the banks to bear. And in terms of provisioning, certainly if they go for 100% provisioning, I see a cap on the interest rates, and interest rates going up in recent times, as we've seen in terms of RBI going hard on consumer loans with increase in risk weight assets on consumer loans. Now, this is another step. So I certainly see there would be an increase in interest rates if RBI goes hard on this. But certainly at the moment, I see RBI would give certain time extension on this. They found out a problem statement, but there's no solution as such, and the banks would certainly be hit hard on this.
Okay, you're right actually, but there is any way where we can guide to the regulator industry that how they can carve out the genuine transaction out of this directive? How it can be done? Can you give some or throw the light on that if possible?
So possibly in terms of, like I mentioned, referencing, wherein they could map the number of transactions. For example, if 400 as a limit was given and only 100 was used as refinancing, the corporate might certainly have used an amount of 300 for growth. So certainly those genuine transactions would be there, and RBI should frame certain policies around what are the quantum of genuine transactions. Maybe around 20-25% of those transactions might definitely be genuine. But how RBI is framing a policy around that they still are unclear of. And in terms of assigning a clear policy on what RBI steps should be taken to resolve this, it is certainly true that a financer, if Bank of India might be sponsoring one of these companies, the corporate might move to another bank. So certainly the quantum of money would flow from one bank to another, but overall, I see there would be a large quantum of genuine transactions too, along with masking of certain NPAs. So, in terms of truncating those transactions, RBI has taken a good step, but certainly the good players also go out of market here.
So you are right. I think what you said that वो एक अपने कहावत है ना, वो गेहूं गेहूं के संग में घुन भी पिस जाता है, मतलब ऐसे something which is old saying. So I think it is happening here actually. What I believe actually, because Garbi want to catch hold of some people or some transactions, but everybody has been covered, so the entire industry got impacted. You're right. Thank you so much for your views actually. And
Exactly.
friends, we
Thanks,
have the
Ashish.
seasoned. Yes, sorry. You want to say something?
No, you're good. Thank you.
So friends, we have a seasoned banker with us, and he's a banker, and then he was a banker, and now he's the founder of the one NBFC, Sarvasa Capital, Mr. Birendra Gulati. Gulati ji, welcome to you. And I know Gulati ji is long, basically, although we are talking today after a long time. So Gulati ji, being a banker, you have dealt with the developmental financial institutions also. So we'd like to understand that how will the RBI decision impact the other financial institutions like NABARD and SIDBI, especially in terms of their investment capabilities in AIF scheme. Should the RBI make an exception for this? Although I've tried to cover it in my presentation, but I think your views are very, very important for us.
Thank you, Ashish ji. You're right after a long time, and your statement is also perfect that गेहूं के साथ घुन भी पिसते हैं. Actually, to my mind, when these particular regulations were given, there was no process defined, or there was no scheme defined that how the AI funds should be used. That is the reason. Actually, in the Western world also, you see, there is more of a self-regulation today. Today, if you take money and mask the NPAs, that is also not fair. So the knee-jerk reaction was to come today, tomorrow. So if the RBI has given a this action, I think this was overdue now. And the amount you was mentioning 8,44,000 crores. And even if what Vineet has said, 30% or 40% of those transactions are mass transactions, you can well imagine the kind of NPAs within the country. When we say the banks NPAs are coming down, actually it is not coming down. You have to add all these things. When you ask me, SIDBI or NABARD, yes, they are the torchbearer of the government policies. It has to go up. Progress has to be made. Industry has to be given support. That is all fine. But if the funds are used in evergreening of loans, I think this is not done, because this is a risk not only to the banks. This is a risk to the ultimate public also. No, our funds are there in the market. NBFCs also, names will also be spoiled. There is no self-regulation as such. I think this maybe 30 days period given by the Reserve Bank of India is too less. Probably they have to reconsider this. Probably provisioning also they have to reconsider this, and then they have to come out with a concrete scheme how the fund should be utilized properly by the AIFs, and AIFs should also have some self discipline on this, that they should not be falling prey just for income to lend funds to the same entity who has defaulted, who was about to default with the banks. So I don't think NABARD and SIDBI, there may be some little flexibility should be given to them, but I don't think they are anyway different from other investors. And their money, means the government money, should not be utilized to mask the NPAs. This is my view on this particular aspect.
You rightly said, actually, the amount is huge. But one thing I would like to just mention here, that banks' exposure towards this AIF is, in comparison to their investment size and all, is very, very small, actually. So I believe it will not impact much, but from the NBFC point of view, definitely it will impact more. And as you rightly said, that SIDBI and NABARD, all other developmental institutions should be excluded from this jargon, actually. Otherwise, this developmental objective of the government, I think, it may impact it further future, actually. So it is true, actually, what you said, but the RBI has to come out with certain modification or certain guidelines in addition to that, where these institutions should be excluded from that, actually.
And
So thank you,
more,
Gulati sir.
yeah, more or less, Ashish ji, there should be more of a self-regulations even by the AIFs on this issue.
That is also important.
Yeah, that is
Self-regulation.
very, very important for this.
SRO is more important, basically.
Yeah.
So just not for a small money, you are violating the rules and all, basically. So
And
you're right.
NBFCs are also not small. NBFCs are like Piramal and IIFL. There also public money must be there, sir, in some
Correct,
shape or another shape.
Correct. You're right. So they must be having some deposits also from the public, actually. And they are taking money from banks, so it's a bank money also.
Yes.
So thank you, sir. Thank you, Gulati sir. I think you have very well covered regarding the development financial institutions. So friends, we have Vijender Shekhawat ji, who is the CEO and ED of Choice FinServes. So Vijender ji has multi-year experience in the banking and the finance industry. So first of all, Vijender ji, welcome to you. And thank you very much for joining with us. Vijender, you like to understand this thing, in this investment in AIF, bank have invested in the AIF in a company which has borrowed money from the, so bank has invest money and the company has borrowed money from the bank also. So how the bank will know, basically, and how they can keep track on it, basically, because they are giving money to AIF, they are not giving money to the company, basically. So what are your views on that? And will the banks NBFC be reluctant to fund AIFs now? So over to you, sir.
Yeah, thank you. Thank you very much, Prashish ji, for having me here on this call. So specifically on this circular, I have 2 points to raise to the regulator. My first point is that the logic which was given behind this circular, that there might be an evergreening of the loans, right, between banks and also by the AIF. So, saying this, that there is a evergreening, and because of that thought, ultimately stopping, the investment and recalling the amount from existing investors, it seems to be very difficult. Instead of this, for RBI, it might be very easy to get all those entities where evergreening is there. you know uh, it's not like that AIF has a retail kind of a book where they have more than lakh of customer and all these. Mostly their investment is there on the wholesale side. So getting all those data of the AIF investment or further the lending is very easy for RBI. So instead of saying that stop everything and recall all the investment, RBI must have get all those data, and they should give only the direction for those entities or those corporates, right, or those borrowers only, that this is an evergreening. So there is a solution. And then again, as what Patak Saab was saying, that AIF is also regulated and controlled by the SEBI. So this also can be resolved between two regulators. Just because there are two regulators, they don't talk each other, this kind of a directive is really impacting the overall industry. Start from the banks and NBFCs, and also the people who are borrowing from the AIFs, right? Because today, even for the smaller NBFCs, the debt raising through AIF is also become a very good channel. So this is also impacting. So that's my one point. The second point is when we are saying evergreening. So evergreening, in my view, can happen through any other channel also. Why only through AIF? Banks are giving wholesale lending to NBFCs, and those bigger NBFCs also giving loan to the smaller NBFCs, and then those smaller NBFCs are giving to the borrower, right? So that last mile of the borrower can have the lending from all those three four, even from the same bank, even from the same NBFC, or even from the smaller NBFC. So evergreening is happening there also. Like, it might possible. The only solution there is because we are giving in CIBIL, and all these data records are there with the RBI, so they can get all these detail, right? So just saying that evergreening is through AIF seems to be difficult, because there are other channels also. And because of this circular, it seems that tomorrow it might happen that RBI will come out with circular that NBFC to NBFC, this wholesale lending is also not allowed, because there might be evergreening over there also, right? Or any NBFC who has lending from bank, they cannot borrow to the same borrower of the bank, right? So it seems to be like this. So my only view and my request to the regulator is that it has to be thought of again, and then only where they see that evergreening is there, this should be impacted. Otherwise, this is a good channel for everyone. It should be allowed some time, as you already mentioned on in your circular, in your presentation. So yes, definitely, because of the circular, the investment by banks and NBFCs to AIF further uh, will not happen immediately, because everyone will wait for the further guideline, or if any something will allow by the RBI. So this will definitely affect overall industry by this. Thanks,
Very
Ashish.
good, Vijayendra ji. I think you have very well covered also. I think one point which you have mentioned, that it's not a area where the lakhs of transactions will be there. There will be few hundred or maybe thousand transactions will be there, which can be monitored very well, and out of that the black sheep can be identified, and which can be the directive can be issued for them actually, or there can be some action rather than. So although we are not here to comment or to criticize RBI, because we are seeing a smaller picture. RBI has having the larger picture of the industry of the country. So definitely they must have seen something. So maybe in the hurry they have done this directive, but they will come out with certain modifications or corrections in that maybe after some time. But like you rightly told, that it's not a big thing to assess or to understand or to know that which are the transactions which are of evergreen nature actually. So that is
Yeah.
one thing which is very well covered by you. And the second thing that you told NBFC part. So I believe this evergreening to NBFC funding, bank to NBFC, NBFC to other further, because this is more of retail kind of lending actually. If you see in India, this wholesale lending by NBFC has already been, I think, negligible actually. Now, it is very, very less in the overall. I think 32 lakh crore of NBFC lending is there. Out of that, wholesale lending will not be, if we basically keep outside the PSUs NBFC, basically like REC, REDA and all. There'll be hardly maybe 10-15% of the total portfolio will be of the wholesale lending. I'm saying on the higher side actually. So the chances of evergreening the retail portfolio, I think, is not negligible actually. So this will, I think, this will not impact, and RBI should not come out with this kind of circular or this kind of guideline, because otherwise this will impact the funding to the related retail investors which are unserved and underserved actually, where the financial inclusion and all these objectives are there will be impacted a lot actually, because this can be controlled. If this will be the situation when they will stop NBFC to NBFC funding, this can be. Although RBI has said very recently that NBFC should look out the diversification of their funding sources, which is that parlance they want it that they should not be dependent on bank funding basically. So consultation risk should not be there. But they have not given any indication that any kind of evergreening or this possible. So it's a good point which you have, I think, throw the light on that actually, and we hope that RBI will come out with some regulation on that. Thank you very much, Vijendraji. So
Thank
now,
you.
friends, we have Mr. Vikas Dugar. Vikas ji having the previous avatar on the AIF, then now he is the part of corporate M&A, corporate strategy head, and he is part of the large joint in the pharma sector. So I think we thought when we were finalizing the panel, we thought let us understand the view of the corporates also, because corporates, maybe some of the corporates are having the separate AIF, but many corporates are funding from the corporate book actually to the startups or to the industry companies. So what they think about it. So first of all, Vikasji, thank you very much for joining with us and at very short notice. So Vikasji, we would like to understand that AIF have in the recent year funded the several startups, and you know that more than 100 unicorns are there in India. What sort of other unintended consequences are this directive will have or likely to have in future actually? Because this AIFs are funded to startups, and startups are raising debt also. So if you can give some highlight on that as corporate investment arm, how do you see this circular, or how do you see the future of this investment in the startup space? Over to you.
Thank you, Ashish. Maybe I'll just start with my introduction. I kind of lead the corporate M&A, corporate VC arm at Cipla, and I'll just explain to you guys what corporate venture capital is. Most of you are already aware. What we do is that out of our cash, Cipla's own cash on the balance sheet, we acquire companies in the pharma space and consumer space, and that's what we call M&A, merger acquisitions. And the other piece which we do is that out of the same money from our balance sheet, a small part actually goes to acquire, or I would say take minority positions in startups, and that's where we kind of operate just like any other VC or PE fund, where we kind of fund their growth just like a minority investor. And we also bring, apart from the capital, a lot of our network, our reach, our distribution reach, as well as our connect with the wider healthcare ecosystem of doctors and hospitals. So that's what broadly we do at Cipla. We have also invested as a corporate in a couple of AIFs actually. These are largely VC funds specializing in healthcare and consumer investing. And the idea is not just financial returns, but also partner with them to understand the wider healthcare ecosystem, what kind of investment opportunities they are looking at, and their broader thesis of what's happening in the startup community. And we ourselves actually keep on kind of meeting and evaluating various companies for investment ourselves. Now, coming to, and prior to joining Cipla, as Ashish mentioned, I was part of a private equity team in India, in fact, three of them, and have been investing in different sectors, including consumer healthcare, e-commerce, retail. So today, maybe I can give you both a perspective and my limited perspective. I don't claim to be an expert in this area anyways, and it's a pleasure or a honor to be part of this team or panel, learning from different people here. What I can kind of give a limited perspective is one from the point of view of corporate, as well as from the point of view of a investor or a private equity fund who has got kind of funds from a bank or a NBFC. Now, coming to the first point of how a corporate is looking at this circular, or a corporate like Cipla, who is investing out of own balance sheet, is looking at this circular. So frankly, because we are using our own money from our balance sheet, so the circular actually doesn't impact us anywhere. And the other piece is we being invested in other P and VC funds. They do have, or in fact, we have two such investments, and when I check with them, they also have very, very limited kind of funds coming from any bank or an NBFC. So, from a corporate perspective, who doesn't have third-party money, this circular is not that relevant from my limited point of view. Now, there are certain corporate VCs who have or are trying to raise third-party money, who have had one round of kind of funds from their parent corporate, and then now they are kind of trying to raise third-party money, build a larger corpus, and maybe earn money using fee and carry. So they would be looking at banks like SBI or Bank of Baroda for funding part of their corpus of their AIFs, and that's where, given the circular, there might be a temporary kind of slowdown in such investment for the time being. Now, what's kind of my view on this circular? So I would say that it's premature actually today, and maybe a step back there, that I would say that the intent of RBI is very, very kind of strong and clean here, and it is in the right direction. And given the complexity of the space itself, given two regulators, RBI and SEBI, and kind of the AIF space itself being highly fragmented, it's not like maybe more than 1,000 AIFs, more than 500 private equity VC shops in India, kind of getting funded from multiple sources, banks and NBFCs. For a regulator to get a very refined set of regulations on day one is difficult. So I think what RBI has done is put their intent or made their intent very clear, and it's more around, I would say, a beginning of kind of a process where these regulations will take some shape, and will take maybe a couple of months, or maybe more, where they will invite kind of inputs from various stakeholders, including the banks, NBFCs, the VC community, to understand how this can be done in a manner which doesn't hurt the wider investing space, and at the same time takes care of evergreening. So I think for us to look too much into this circular as to what exact impact would be there, I think is slightly premature in my view, because when I read the circular, or what we discussed earlier on this call, a 30-day kind of window to liquidate your AIF units is something which is, I won't say impossible, but highly, highly difficult for anyone to do. So what most banks and NBFCs are doing, and you would have read in the newspaper about IIFL and whatever, Piramal making provisions, because that's something which is in their own hands. And they've done very promptly those provisions. It didn't take them more than a week or 10 days to do it. Now, coming to the point as to how a private equity fund will get invested immediately out of this circular, in my view, as I mentioned, it is going to maybe lead to certain slowdown in the immediate commitments from banks and NBFCs, and everyone would wait for this for the regulations to become more clear and crystal before committing any money to any new PE fund. For example, SBI or Bank of Baroda, all these banks have fair bit of commitment to more than 50, 60, or maybe more than 100 AIFs. And I won't say that these commitments are very small, because RBI itself doesn't allow, I think, more than a 3 or 5% exposure to alternate investments, including AIFs, for any bank or regulated entities anyways. But given SBI and Bank of Baroda are so large that the overall, whatever, that 5% itself is a big number, that and they don't want to take exposure to a single AIF or a bunch of AIFs, so they've kind of diversified, invested small chunks of money in kind of hundreds of PE funds. What I see in the short term is that all these investments, which most of the banks have done, including SBI and Bank of Baroda, their exposure is less than 10% of a fund. They are not exactly taking any decisions there. So RBI will, in my view, take cognizance of this fact that it's something which is very passive. SBI has invested in a PE fund, and they have any control over where the PE fund is actually putting money in a SBI funded company or not. They are not on their investment committees, or they are not taking any kind of participation in their investment process. So I think those exceptions will come. The other piece is what about NBFCs like Piramal or IFL or Edelweiss, or banks like ICICI Bank, who have, or a Kotak, where they already have a big business, separate business, which is asset management there. And the idea, I think, when they started all these businesses was kind of very genuine, that it's asset management business and let's kind of earn money out of fee and carry and managing kind of third party money. Now, I think and they have all these are very well governed business houses, so they've promptly made provisions. That's the easiest and quickest things to how to comply with the regulation. But what I hear from all these people out of my kind of network at all these places is that any which ways these all these business houses, through their internal kind of regulations, or I would say best practices, were not exactly exposed a lot to the same company. For example, a Piramal kind of investing into the equity shares of a company through its AIF, at the same time Piramal also NBFC providing loan, because they also realize that having too much of exposure to a company through my debt arm as well as my equity arm actually is detrimental to me. It increases my risk overall kind of group exposure. So most of them actually had good risk management practices, have such practices, already have I would say limited overlap, where a lot of their AIFs investing into equity and their kind of NBFCs in kind of providing debt is limited. So my kind of view on this circular is that it will, just summarizing, it will evolve. Most people have made provisions. I think the secondaries will take a lot of time. I don't think that's a very practical solution to it. Provisioning is the norm there. Long term, I think once regulations are crystallized, things will come back to normal. Short term, yeah, the investing into AIFs will certainly slow down. And I think it's a right direction what RBI has done. Long term, it will increase better governance at whatever the NBFCs and AIFs. Thank you.
Yeah, very well said, Mr. Vikas. I think you have covered many things from corporate point of view, from the banking also, and RBI directive also. And as you rightly said, these corporates will not be impacted. Those are having their own money investing in the AIFs or maybe the investing companies directly. So, although this circular is not covering this area as of today, uh, but the AIFs which are taking public money, definitely they are getting impact of it. And you rightly said that it's too early to decide whether RBI will stick in on this, or they will come out with some more directive also. But I think with that discussion, with all these five panel speakers, we have come out that it's very, very difficult to get exit from the AIF's units within 30 days, which I think everybody has agreed. So also, I think because you know there is no secondary market, there is no regulated market also. There is no taker of these units. So, and somebody has told that there will be 30% 40% cut if somebody want to sell it and all. So this will directly post in the losses of that entity. So I'd like to understand if any of the panel can cover on that. Basically, this timelines which they have given, or we can discuss on the secondary market, basically what should be done for creating the secondary market for the AIF unit. So because as you have seen that 8.4 lakh, 44 lakh crore is not a small amount actually. And there'll be maybe the banks and NBFC are there. There are many family offices are there. Many other individual HNIs are there. Those have invested. So, and this industry has matured to 10 years now. I think almost 10 years are there when the regulation came in India. So if we can throw the light, we have discussed a lot on the circular, but this one aspect which is not there as of today in the country, and we have seen the mutual fund capital market. So what would be your suggestions? If anybody would like to take this question or like to give the suggestion, so that it can be a fruitful discussion from the regulator point of view or on the industry point of view. So open for all. I think let us have discussion on that. I think that we good actually. So anybody would like to cover on that because we like to. Because you have worked in the AIF
Mr.
industry
Pathak,
earlier also,
Mr. Pathak,
or
please.
any international practice, such practice is there. Where, pardon, sir?
Mr. Pathak, please go ahead.
Pathak, please, you take it.
Yeah. So, Ashish ji, in a very informal way, we already have a secondary market, but it is, I mean, it's too premature, too early for them to take up, transactions of this scale. Because right now, what is going to happen because of this disruption, we will have, everybody going for some kind of relief measures immediately. Having a cut of 30% on the portfolio is going to be a major that will have a major implication over the profitability. Nobody wants to do that, and given the timeline is this small, 30 days, it will be very difficult for the banks to find buyers for such assets immediately. And also for the companies, for the downstream entities, it will be very difficult to manage this kind of fund immediately if they want to retire such loans. So even though there is a secondary market available, people do securitization, people do portfolio sale. So that happens, and that happens without having any regulation in place. But doing it when people know that there is a requirement from RBI to carry out within a certain time frame, it creates a market which is not conducive for the banks to handle. So
I'm sorry to interrupt you, Padaji. I think we are just trying to understand from the AIF exit, AIF investment exit point of view. So suppose I have investment, I've invested as a HNI in one AIF, maybe 5 crore rupees. Tomorrow, because this is a 7, 8 year, 9 year investment. If I want to liquidate my money, maybe it may be on the higher NAV or lower NAV. So there should be some regulated market because it's an industry of 9 lakh crore now today actually. So and RBI has given a directive that they have liquidated their investment in the AIF within 1 month actually. So we see the future basically, and if there is such international practice also where the AIFs can exit from the market and all from the investment in the from the secondary market. So if we can discuss on that, I think that will be good. If we can cover on that.
Yeah, so right now there is no such market. We know that. I mean, we have whatever arrangement we have is very, very informal. People will do, and within the kind of time frame we are given, it will happen very, very informally, and it will not be very conducive for the seller. So, but eventually, if the policy framework allows and there is a clear policy guideline from the RBI and SEBI, such markets would emerge. Such practices would also come up over a period of time. But in the near future, there will be some initiatives in this direction. But right now, within the kind of time frame we have been given, I think it will be very difficult to have a fair market in place.
Correct.
I agree with you, sir. 100% on this issue. There is no regulated market, and we don't foresee 30 days time will create a market for such a disposal. Liquidity will be tough. RBI has to come up with a time frame in which more time should be given. That is okay. But ultimately, the main core of the things will remain the same. That self-regulation has to come in the industry, and this problem will also get resolved. It is there because it's not small time money involved into this. The government also will be concerned on this issue.
Yeah, so you're right, sir, Glati, sir. But I see that this the government securities and all are also issued for 10 years, 15 years basically. But there is a market that somebody want to exit, he can sell in the secondary market and get this money basically.
Yes.
That's a one aspect. And you see the the broadening or the widening of the market also, this AIF market, the number of investors would increase, domestic capital should be more. I think the secondary market will be there. There'll be more investors who will attract, not from the domestic market, from the international market also. So I think a lot of transparency will come also. Today, if you want to see the NAV of any AIF, it's very difficult to get the NAV at on the transparent manner on the day-to-day basis. That what is the NAV, or maybe on the monthly basis also. So I think this debate is required now after the circular. That I think before coming this circular, if we bring this circular, the government should think of creating some kind of regulated market for that also. So that is my question, and I will be happy to basically listen or understand from the panel. If you can throw the light on that, or if there are any international experiences or there, what do you think also that will be helpful? Because a lot of people are listening us from the different part of the industry. So they will also, I think, take this voice to the different channels also, different this forums also. So
Absolutely, Ashish ji. If we have a regulated market, secondary market for AIF investments, this will actually, more than anybody else, it will help the AIFs themselves, because this will bring liquidity for the LPs, and also not just LPs, even the GPs will have more liquidity at their hand, and even ultimately fundraise or access to capital would become easier for them. But yes, I mean, we need to have a proper policy framework for something like that to emerge, because using an event like this to push a market like that might not be the most ideal thing to happen. But yes, I believe, as you rightly said, this event will give some kind of some people will take up this as an opportunity, and there will be more clarity on the kind of policy framework that is required for a secondary market like that. And we believe that people from SEBI and RBI will take note of that, and the right kind of policy framework would be put in place.
Right,
just
right.
want to kind of,
Because you would like to
I just very limited. I think we are overshooting our time. So just limited point that look for a market to emerge in AIFs, and I think AIFs are a very wide word being used here. We need to look at the underlying assets what AIF are investing into. So AIF can invest into a listed security, can invest into a debt instrument which is very liquid, which has a cash flow which is known, and then AIFs. A lot of that, the AIFs are actually investing into unlisted securities or private companies. So question is, maybe there could be a market for AIFs which are exposed to listed securities, many of them. But a whole chunk of it is the underlying securities themselves are so illiquid that I'll give you example. I was part of a fund in my earlier avatar, which was a fund kind of which was backed by a bank actually. The bank was IDFC, and it was IDFC Alternatives, which was a subsidiary of IDFC bank, and then IDFC Limited actually. And when you say that you have to do a secondary of any such fund or any IF, actually 30 days you can't do anything actually. You can't even make a deck which can go out to some prospective investors with a updated valuation that this is what it is and why are you interested. So it takes at least a 6 months to 12 months actually for someone to diligence a AIF in detail and say that okay, I am ready to buy a 20-30% stake from someone else. And it is true globally as well, because the underlying securities are so illiquid, and as you mentioned, the NAVs are not that crystal clear, although they are done by big four accounting firms. But anyways, valuing a private company using a DCF and all is more, to my mind, is also to some extent an art rather than a science. So ultimately, as I mentioned earlier, liquidating or selling the secondaries of AIF units will be a very limited choice for most banks. They can sell in very good performing funds where they've invested, but majority of the funds are not that great performing or not that well known in the investor community. Having said that, there are very specific institutions which buy such secondary stakes. Newquest and many of the kind of bulge bracket PE funds have their own secondary arms, like a Blackstone or TPG. just doing this thing, buying secondaries of other funds or other companies. But as I mentioned, 30 days is too small a period to for even a process to kickstart. Actually.
Okay. You rightly said actually, because unlisted listed components are there. So there might be some difficulty, but there can be some formula, regulated formula, which can be worked out, where even the partial exit is possible, which can be done also. The listed part exit can be possible, unlisted part. So, because we are just, I think, throwing the stone in the ocean, actually, we are just discussing that what can be done actually, just to create a liquidity platform for the AIFs. So, how it will come, what will come, what are the international practices which need to be discussed? I think this is a food for thought for everybody. So, Biniji, want to cover up something on that. Vijender ji, your views
So,
also. Put it.
my view here is RBI could implement something in a phased manner wherein they could make it in tranches, maybe 20% by March 22, then a quarterly phase out by December 31 next year, so that it is better aligned in terms of an overall regulatory perspective as well, and it aligns to banks' car requirements or even in NBFC's car requirements, and they don't take a hit on the balance sheet all of a sudden, which would create an all of a sudden impact in the market as well once they start writing off those loans. Or so probably it could be in a phased out manner and then all of a sudden.
Very good idea. I think so. This is a good suggestion that it should be done in the phase out manner actually. Good, sir. I
Yeah,
think. Yes,
yeah,
sir.
this is same thought with me also. But I think after this circular, all the people from the financial industry are, sending their views even to the regulator also. And I'm sure after all these things, RBI will definitely come out with some of the, solution on that, because this is really a good channel for all the people. So yes, agree that in phase manner, RBI may come out with some guidelines that this will continue, but with some of the guideline which will be defined by the RBI, right? So let's see how it will go.
Great. So we have one question, I think, which already been discussed. I believe somebody raised this question: is the RBI directive directed only cases where the green washing is done, or to all investments in AIF? So I think it is for all AIFs, not to the selective AIFs and all basically. So just to question your answer, audience, I think from my view, it is for all AIFs. Any panel speaker can also comment on that. If there are different views on that, actually. So this directive is covered to all AIF or only on the greenwashing AIFs, basically. So that's the question.
So it is for everyone. It is in order to prevent green funding, but it is for everyone irrespective.
Okay, got it. So good, sir. Thank you so much to all of you for making it successful. Where we have discussed on the various aspects of the circulars. We have tried to decode it in such a manner where it should be very simple. And many things have come out from this discussion. One is that this 30 days is very, I think, a small period. Actually, the RBI should think of either doing in the phased manner so that there's not be hue and cry, or there's not be the larger impact on the balance sheets of the regulated entity like the banks and NBFCs. And the developmental financial institutions should not be the part of this kind of directive, because their role is for developmental. They have to meet the government agenda on many aspects. So this is another aspect which has come out from this discussion. Third is this the some secondary market. Although there are different views of the panel where whether it will be possible or not possible, but I think something can be thought of, or there can be food of thought on that, how it can be created so that the more investors should attract towards it. The global money can also come in a big number, big amount for making this industry more vibrant, like mutual fund and all. So I believe that these are some of the areas which I think have been discussed in detail, and our panel has also suggested many things. So I would like to thank you once again to all the panel speakers for joining with us on very short notice on this in this webinar. And I would like to thank you to all the audience also, the participants who have joined from different background, different places also, for listening us and giving us some questions also or suggestions also. So once again, I would like to thank you to everybody and wish you all very, very happy New Year. And I wish that the coming year will be very, very I think good for everybody with terms of their health, wealth, and everything. Thank you, everybody. Thank you so much.
Thank you, Ashish ji.
Thanks.
Thank you
And
very
I
much.
think the self-regulation should be the key for AIFs. And
Self-regulation
for
is
the
number one.
regulator, it should be, giving more time to have the self-regulations also.
That's another suggestion. I really thankful to you, sir. I forget to mention it actually. Thank you so much. Thank you.
Thank you.
Thank you.
Thank you, everyone.
Thank you, Ashish.
Thank you,
Thank you,
everybody.
everyone.
Thank you.
Thank you.
Thank you.